Welcome to the Life Unlimited podcast with Larry Heller. You deserve complete financial advice so you can confidently live your life your way, for life. Now, let's get into this week's podcast episode.
Hello and welcome to another Life Unlimited podcast with your host, Larry Heller. Today we have Stephen Davis, the president and CEO of Safe Harbor Asset Management. Now, over the last 4 decades, he's had experience in financial services, but specializing in tax avoidance strategies to enhance client net worth. For 17 years, he's focused on 1031 exchanges, which is what Larry is going to dive into today. So Larry, take it away.
Thanks, Matt. Thanks, Steve, for joining us today. I think
pleasure.
people are going to be very well informed because
so.
they've heard kind of this 1031 exchange, but I think a lot of people don't even know what it is, that it even exists, and how beneficial it could be for certain people that have certain appreciated assets. So why don't we just kind of start really right from the beginning, so for our audience, and really kind of high level explain what is a 1031 exchange?
Quite simply, it's the ability, given the IRS approval, for the exchanging of one piece of property for another, often referred to as like kind, but really means any real estate. If it has bricks and mortar, if it's dirt, even a lease is considered property. So if you own a property and you're selling a property and you no longer want to be active in the management, the provision allows for the sale of your property through what we call an intermediary or QI, who handles the transaction, not the closing, but the handling of the money. And then when you find your next property that is probably passive, that you don't have to manage, they acquire it for you, and then they transition the title to you, and thus you accomplish an exchange.
Right. And the magic of doing this exchange is that you get to save a lot of money on taxes, correct?
That is absolutely certain. You get, we call it a deferral of the taxes, as long as you maintain the transaction in perpetuity, meaning every time a property is sold and you do another one, you then successively defer the taxes on the capital gain. And what is important, where your family is concerned, is the taxes are abated when you pass away. It's called the stepped up cost basis, which you're familiar with, Larry, and most of your clients are. So that means you receive income from your real estate, you take the tax benefits from the depreciation on the real estate and any other expenses, and then when you exchange and exchange and exchange, and then you ultimately pass, then your family receives that stepped up basis and all taxes go away.
Yeah. So let me just kind of lay it out in numbers for the number of people out there. So let's say you bought a piece of real estate for $1 million and it's grown to $10 million, and you want to sell, and if you sell it, you're going to pay taxes on that $9 million gains in capital gains. That could be, $3 million, close to $3 million. But instead, like Steve said, is you can exchange this into a like-kind property, defer the taxes, and then when you die, whoever's inheriting that gets the stepped up in value from 1 million to whatever the market value is, and they would avoid paying any capital gains.
True.
So that's kind of how it works, and that's why it's so powerful, because there's so many people that've got a large unrealized gain that they may be sitting on and want to take advantage of that. So why don't you kind of give everyone your perspective of the benefits of the 1031 exchange? I mean, we just talked about the taxes, but the benefits of the exchanges today.
Typically, in my experience, the people who are tired of dealing with the real estate, excuse me, which, they call them the 3 T's, toilet, trash, and taxes. Those
I don't think I've ever heard that one before, but I like that. 3 T's: toilet, trash, and taxes. Okay.
So the the benefit of the exchange, of course, aside from the tax benefits, is you relinquish the responsibility, the daily, day-to-day management of property. That's a primary benefit. There are ancillary benefits too, because when you go into a passive investment, and backing up, most people who sell a property, let's say they have a rental property they've been dealing with for a number of years, and they sell it, they don't want to buy another rental property. So they're looking for an alternative. They may turn to a triple net, CVS, Walgreens, Starbucks, Tractor Supply, buy a property like that, or they can invest passively into a Delaware Statutory Trust, which we'll get into. But they have now alleviated themselves of that responsibility of that day-to-day management, and to a large extent financial responsibility, liability, trip and fall liability. Things happen in real estate. So getting away from those responsibilities and liabilities is the primary reason. And most of the people tend to be at or close to retirement. Some people, even not at retirement or younger, are realizing the benefits, the same benefits, but they get the benefit of ownership and the tax benefits without the headache of managing property.
Right. So they're converting the property. They don't really have to manage it anymore, but they're still going to get the incomes. If they had a rental property, they're still getting their income, what you call passive income, but not managing that. And they're getting to defer any taxes on any of the gains. Sounds like a pretty win-win-win situation, Steve.
Frankly, when I lecture and I explain these things, I personally believe that this 1031 exchange is the single best investment premise that we have in the country because of those benefits. I don't know of anything that beats it. Do a pension plan, put the money away, but when you pull it out, you got to pay taxes, not necessarily at a lower tax rate either. So yeah, I think it's a fantastic proposition.
Yeah. So let's talk a little bit about like kind. What do you mean by like kind?
Like kind does not mean if you sell a house, you have to buy a house. It merely means any form of real estate, from shopping centers, student housing, apartment complexes, office buildings, which are not really much in favor at the moment, but any real estate is considered like kind, but uniquely. One that there are two that is often overlooked, particularly in our metropolitan area of New York City. There is the air rights above a building. You could literally sell air rights and do a 1031 exchange. You can create income out of thin air. Have done that before. And also a lease. If you have a lease that is over 30 years, you technically own the property. So we've actually done exchanges for people who did not own the real estate, but had a long-term lease. And they were selling the business with the lease. They were able to apportion a value to the lease and do a 1031 exchange.
Into another piece of income producing property.
Right.
No, great stories. Do you have any, kind of specific stories on how an exchange has really helped somebody?
Sure. I'll give you a recent one. We had a client who was referred to us who owned the building in the city. Paid in the neighborhood of $1 million. It was selling for about just shy of $6 million. Problem was he had refied the property some time back, and then the loan that was now coming due at a high rate. He was going to have to pay, I don't know, 8 or 9% interest. And it basically used up all his positive cash flow. So now it became a drain. But the problem was he was leveraged close to 74%. You could, very difficult to go out and buy another property with 25% down, a commercial property. We have a mechanism using a Delaware Statutory Trust designed for this specific reason that has higher leverage, so that we were able to get him through the exchange into another property even though he was highly leveraged, we were able to secure and maintain all the equity, and his cash flow was somewhat reduced because of the leverage, but he still was able to walk away with somewhere in the high threes cash flow. And if he had sold the property and had to pay the tax, his net equity would have been about 600,000 versus the 2.6 million I think we were able to conserve for him. So his income is getting on the 2.6 million. Yeah, so that's a recent story.
Yeah. So let's just jump ahead. We mentioned Delaware Statutory Trust, DSTs. So why don't you explain kind of simply as best you can what a Delaware Statutory Trust is and how it works?
Well, we refer to them as the DST. So the DST is a provision in the code that allows for an investor or an investor group to acquire a piece of property. And the sponsor, who is the creator of the product, let's call it a product, under the DST umbrella, he'll acquire, let's say it's a garden apartment and it's $100 million. And so they will divide that up into shares, and the DST allows for about 500 accredited investors. So an accredited investor could buy a portion of that particular DST and qualify for the exchange. Delaware Statutory Trust is not a product, it's a provision. The actual product is the underlying real estate that complies with the rules of a DST.
So if somebody has just their own two-family home in, let's say, Brooklyn, that's really appreciated, and they kind of want to go ahead and do this, they don't really have to find another piece of property on their own. They're going to be looking to put it in something that's a lot more diversified, can provide income by using a DST. When you expand on that a little bit more.
All right. Well, I'm going to use the example you just set, a two-family home. And we have one going on right at this moment where someone has a two-family home. They lived on side A and they rented side B. So of course, side A, they get the couple's $500,000 exclusion. Again, highly appreciated from what their cost basis was. So they're technically bifurcating the sale. The portion attributable to the rental side is going into a Delaware Statutory Trust to preserve the tax benefits and also generate income. The side A that they live in, they're going to use their cost basis for side A and their $500,000 allowable exclusion, and they're going to keep the cash portion that remains from that. So that's one way to use a Delaware Statutory Trust without having to buy another property. I'm not sure if that answered the question right. You can ask it again if I didn't.
Yeah. So, I mean, that's a great use of that, but I'm just looking at somebody who's at this point wants to sell one piece of property, doesn't want to be involved in another piece of property. Some of these DSTs are diversified in different types of investment. It doesn't have to be one. It's not one specific home or one specific commercial property. Like you said, you mentioned garden homes, but there are a lot of different types of these DSTs. Why don't you kind of expand of like the different types, the that you see in these, the ones that you like, the ones that you've used?
Knowing that investors have preferences, of course, they might like one type of property as opposed to another. But we have, I already alluded to, multifamily properties. Those are typically resort-style garden apartments that are relatively new, southeast, southwest, not so much in the northeast. And then we have student housing. In every university in the country, around the university, there's a university housing, and then after the first or second year, they kind of move out into rental housing that is designed just for students, and those are pretty good because they only live in it during the school season, and the owners of that, they they're not saying 12 months worth of wear and tear, but and the parents, of course, have to guarantee the lease, and that's a pretty stable type of property. Then you have industrial properties, Amazon distribution centers, for example, they're pretty popular right now. And then there's smaller industrial space. We have life science properties that are purpose-built for drug manufacturers, typically. Then you have office buildings, less so right now because of after COVID, there's been a diminution of the lease up of office properties, but we have government buildings that are guaranteed by the US government. Triple net lease is very popular because the responsibility of maintenance is attributable primarily to the lessor. So let's just use CVS. CVS, they have a store, they don't own the store, they lease it. The owner of the store doesn't have to pay for any maintenance on the property, doesn't have to pay taxes, doesn't have to pay insurance. That's what they call triple net. So the responsibility is all on the shoulders of the lessor. Lessee is free from that. So the triple net is a popular one. Over 55 communities and homes for for seniors. That is also a popular one. And it does change from time to time. And something that's kind of new that I particularly like, it's the build for rent housing. So you'll have a developer, could be Pulte Homes, for example, will build 150 homes in a community. And as a portfolio, an acquisition company like Blackstone, which they have, buy the whole community and rent out the homes. And why that is particularly of interest is because the multifamily, which is a one or two apartment, as the married couples living there, they kind of outgrow it. They have one child, then another one comes along. They would like a house. Maybe they can't afford a house yet, but they could rent this house in these communities. So that is another type of investment property that has begun to become ubiquitous.
On a side, that's become very popular, especially out in California, that some of the states are thinking of not allowing these corporations to buy these block amount of homes and renting them out because they're pushing the price of real estate up. But that's still good for the existing deals.
Well, there are affordable housing investments that can be, in a DST. I don't often see them, but I know they do exist. So that doesn't preclude, having affordable housing. And I totally understand the dilemma that this creates, but we have to work within the climate that we have.
Yep. So let's talk about, I think we've touched upon some of the benefits of a DST. Are there any disadvantages or any other benefits that we didn't touch upon?
Well, there are some disadvantages. A DST is controlled by the sponsor. The investors, and then we call it a Delaware Statutory Trust because there is a master trust that is the management entity for the property. Each investor is a subtrust rather. And those trusts are listed on title with the municipality where the property is located. That is a necessary element of a successful like-kind transfer. So you don't have any control on the property. You're really at the mercy of the sponsor. So the sponsor and his longevity and his integrity and his successful track record is very important. In addition, you can't really sell it. They say, well, a secondary market, there may be secondary markets that will make an offer, but it's usually at a substantial discount to your current price. And so that's not always a good idea. You really wait for the sponsor to sell. Now, that's not a bad thing because the sponsors, and because they're experts at this, they kind of know when the right time to sell is. Typical holding period for a DST, I've seen it as short as 3 years and as long as 10 years. Average is 5 to 7. which means they kind of tend to roll over. So you hold it for a period of time, then it rolls and you do another DST, and you're moving forward into new property every so often, all remaining in the passive environment. So there are some disadvantages to the management of the property in a DST. They can't call you up and say, you have to send us a check, we need more money. It's not a partnership. They can't do that. So they have to have in reserves the money that they need in their infinite wisdom of going forward, what they're going to need to maintain the property. So a portion of rent, of course, is always attributable to maintenance. So they can't do that. They also can't refinance a property. So if there's a situation where a property got into trouble for any one of a number of reasons, which can happen, they cannot refinance a DST. Let's say they've had to hold on to the property a lot longer than they anticipated, and the loan that they used, if it was leveraged, comes due. Well, the only thing that they can do around that is to flip the DST into an LLC. So it becomes from a DST into an LLC, then the LLC can refinance. But if it remains in the LLC, if they sell it, you can't do another 1031 exchange. So they would have to flip it into the LLC, get their financing in order, and then flip it back into a DST.
And that's not a taxable event to.
No, because there was no sale.
Okay.
So that's a way for them to manage. So those are some of the nuances of a DST. If it was a partnership, if you were exchanging into a partnership, you don't have those limitations.
Right. So you said a lot of these last 5-6 years. So if you wanted to get out and you decided you wanted some of this money back out earlier, you're kind of limited to some of your options is what you're getting at.
You are limited. So that's why it's imperative to understand what the client wants and needs in the beginning. If they need money from the transaction, they only have two ways to take it. They could take it out as what they call boot, which is taxable, or in anticipation. We do have some mechanisms within the DST field of product arena that we have, where it does allow a cash out at a certain point in time. It's actually designed to let you cash out without violating any IRS provisions. And the problem is it's not really designed for small transactions. They're typically no less than $1 million, but between 1 million and above. We've seen them for 100 million, where people will cash out a portion of their equity from that DST. Gets a little detailed. I'm reluctant to get into the weeds here, but
yep. So of course, now someone's selling a property that they've managed and they're going into these passive investments, and that's not really what their expertise is. So I guess that's where you come in by kind of discussing what they're looking for, and you're able to guide them as far as which is the best DST for them to go into.
We subscribe to the premise of diversification. And so because I have access to anywhere between 30 and 40 DSTs at any given time, we're pretty adept at picking the ones that we feel are the best, but allowing for diversification. For example, we might have 4 DSTs in a $5 million portfolio. We might have student housing, we might have triple nets, we might have some industrial, and we might have a high quality garden apartment. So we're diversifying by geographic location, by sponsor, and by property type. That kind of spreads the risk, more like having a portfolio of many properties than just one.
Right. So you're moving from one property into multiple properties with, like you said, spreading the risk and different types of income streams, different types of returns.
Right. I'll add something to that because you won't ask me the question. I know
okay.
you won't. I'll give you the premise. So when you do a 1031 exchange, and let's say just the simple $1 million, You paid $100,000. Now it's $1 million. You do a 1031 exchange for, into another property. If you exchange $1 million for $1 million, your cash flow, let's just say it's 5%, 50,000 is going to be fully taxable. So when if you utilize DSTs that have leverage, and today the leverage can be between 30 and 55%. So let's just say it's 50%. So if you have $1 million and you have a 50% leverage, you're going to go into $1.5 million of property. Now you have $500,000 of additional real estate. Excuse me. And that's going to give you some depreciation. That's relevant because now your cash flow is going to be offset by the depreciation from that additional purchase. And if it's residential, it's 27-year depreciation. So that gives you some tax benefits as you're going forward.
Yeah, that's a great idea. We're getting into a little bit of the weeds here a little bit more. So any final words that or comments you want to make about the 1031 exchanges?
I pretty much think we covered it, Larry. I can't think of anything specific.
Okay. Yeah, well, I mean, we covered a lot. So if anyone is out there, has a property or thinks they may have somebody that is a good fit for this, where can they get a hold of you, Steve?
We're online, safeharborassetmanagement.com, or it's investsafeharbor.com. So that's our website address. That'll show our email and our phone numbers, of course. We have on our website for accredited investors, all the properties we have listed at any given time. By request, they can request a password to that page. And then we could show them, they could look at properties, on their own. That's the best way.
Great. Thanks so much for joining us today. This was very beneficial. Thanks again, Steve.
Pleasure, Larry. Thanks for having me. Have a great day.
If you know anybody who is about to sell some real estate and really could use any of these tactics that Stephen talked about, please make sure that you either reach out to Stephen directly or you can reach out to Larry and the team at Heller Wealth Management. This is a big deal. There's going to be a lot of wealth that is transferred here in the next 15 years, and a lot of that is within real estate. So make sure that you know when to use a 1031 exchange. And even more importantly, if you know somebody who is about to do that, please share this show with them. If you have not liked or subscribed to the show, please make sure that you do. And please make sure that you follow not only Steve, but you also follow everybody at Heller Wealth Management. So for Larry, this is Matt Halloran, and we'll see you on the other side of the mic very soon.